Hi, I'm Tracy Sofra and welcome to the Women of Wealth podcast, dedicated to helping women achieve financial independence and thrive in every area of her life. In today's episode, we're going to be diving into an exciting and essential topic of understanding the share market and how to invest in it. And well, I think it's exciting and I'm going to share all the bits and bobs with you. So once and for all, we demystify it and you get a better understanding of how that works. So whether you're a beginner or someone looking to brush up on your investment knowledge, today's episode is all about investing and demystifying the share market, exploring how it works and giving us the tools to start investing wisely. So if you've ever been curious about how people make money from stocks, the word stocks is the same as shares, share stocks. So if I use the word share and then stock, it's the same thing. So if you've ever been curious how people make money on shares or stocks or how to navigate the ups and downs of the share market, then this episode is definitely for you. So let's start by, first and foremost, what is the share market? Well, first, let's start with the basics. Simply put, the share market is a marketplace where investors buy and sell shares of publicly listed companies. Publicly listed means, and listed means on the Australian Stock Exchange. So these companies represent a small ownership stake in the company. When you buy a share, you own part of that company. So typical example, most people will understand Telstra shares. Telstra is a publicly listed company on the Australian Stock Exchange. And if you have shares in Telstra, you own a part of that company. And as the company grows, so can the value of your share. In Australia, the share market is commonly referred to as the ASX, which stands for Australian Securities Exchange. And that is the one that you will hear about all of the time, and they'll be talking about the All Ords and so on and so forth. This is where most of the buying and selling of the shares take place. What's great about the ASX is that it allows shares to be a liquid asset. You go in, you can buy, you can sell, and it's what we call a primary market. So when you're investing, one of the key questions you want to be asking yourself is, if I part with this money, what are the chances of getting that money back? Yeah. So on the stock exchange, buying and selling happens within instantaneously, and you can get your money back within 24 hours. So it is a very liquid asset. It's a regulated market which protects you. It means that there are rules in place to ensure fairness and transparency, which is very, very important. As opposed to listed, listed means it's on the stock exchange, the ASX. Unlisted means it's a secondary market. Liquidity is low. There aren't people on the Australian Stock Exchange. Thousands of people come in, buy, sell on a daily basis. When you're not listed, when you're investing in a non-listed company, there are higher risks of returning your capital, getting a dividend, and then being able to sell it because it's not an open marketplace. So that's a major consideration you want to be thinking about. But here's the thing, while buying and selling shares sounds easy, understanding how to actually make money from investing in the share market takes a little bit more effort. So let's break down the next lot of steps. Okay, how does the share market actually work? Let's dive into how it actually works. Let's think about it as a giant auction where investors come to bid for shares or bid on shares. Think of it as a large auction. The price of a share is determined by supply and demand. If more people want to buy shares, obviously the price goes up. And if more people want to sell shares, the price goes down. That's basically how it works. A couple of key terms you want to be familiar with and understand. You would have heard the term bull market. This is where the share market is going really well and stock prices are rising. Versus the inverse of that is a bear market where the share market is struggling. We call it's tanking and prices are falling. So bull market is up, bear market is down. Now, as an investor, you can profit in two ways. This is how you make money on shares. There's two things. There's capital growth and there's an income return. The capital growth is referred to as a capital gain. This is when the value of the share increases over time and you can sell it for more than what you paid. So again, I usually use the Commonwealth Bank as an example because I've been following this share for such a long time. But in the middle of the pandemic, it was a $52 share. Today, it's around $150, $156 share for one share. So it's tripled in value. That's capital gain. That's a capital gain. Buy it for 52 in the pandemic if you had the guts to do it, and it's now at 156. Dividends is the income return. So most Australian companies will pay a dividend. So they pay out a portion of their profits to shareholders. They'll have a great year, a good year, make some profits, share those profits with shareholders, usually in the form of a regular dividend payment. And this is a great way to create passive income. Those dividend payments, most Australian companies who pay dividends will have already paid the tax on those dividends to the tax office, and they will pass that tax credit on to you, so you're not double, so that income isn't double taxed, which means the company isn't taxed and you're taxed on an individual basis as well. So that tax credit is passed on to you. So it's the income from dividends are tax beneficial as well as the tax is already paid to you. But here's the catch. The share market can be volatile. Yeah. Prices can fluctuate daily, sometimes dramatically. So you need to hold your nerve. You need to really have a really good understanding of the share market, what the expectations are, and to know that it is driven by consumer sentiment. A lot of the time, it's driven by what is happening politically, economically. We live in a global environment, if you like. What happens on one side of the planet affects the other side within hours. We are more connected than we ever have been. And all of those, such as the GFC back in 2008, such as the pandemic in 2020, the Ukraine war, the changes in what's happening in America, we're coming up for an election, all of these things impact the share market. What you really need to be mindful of is this: am I in quality shares? Quality shares meaning stick to the tried and true blue chip shares, okay? Don't reinvent the wheel. You don't need to do that. So stick to what has worked over the last 124 odd years, where the Australian Stock Exchange has averaged an average return of 13%. So trust in the history. Trust in what you've seen previously, even though it's not an indicator of future performance. But what do we guide future decisions on? Past history. Yeah, we look for trends. We look for what has happened in the past. We know that quality will always outweigh buying speculative shares. If you want to do some speculative shares, make sure it's a small portion of your portfolio and not the whole portfolio. I sometimes have clients that want to tinker around with a stock here and a stock there, and I basically say, if you want to tuck away 10 grand and do that on the side, that's fine. It really depends on how much you've got overall to decide how much you will tinker around with on the side. But stick to the tried and true methods of what you can expect when the share market moves up and down. And it will be volatile over the life of your investment. If you can't stand the heat, get out of the kitchen is what I say. That is the nature of the beast. But understand by looking at it historically of what it will do, how it will do it. And if you have quality, you hold on, you don't respond to short-term volatility, you don't sell at a low, you don't buy on a high, you do totally opposite of what the market's doing and everybody else is doing, and you hold your nerve and you look at the long-term goal. If your long-term goal hasn't changed, then why should you buy and sell simply because everyone's panicked and, the market's dropped 10, 15%. I mean, that's quite radical. The market moves up and down on a daily basis, but you need to be aware of this. This is the nature of the beast, as I say. So I often get the question, Trace, will I lose my money? You will lose your money if you sell on a low. If you remain invested, that low dip will come back up again, provided you're invested in quality stocks, the top ASX 100 or 200, the all ordinaries. History shows it's done that over time, and it will do that again. If you sell on a low and you take your money out, that means you've lost whatever that drop is. If you were there, it's gone down, you sell here, that's what you've lost. You've lost that money. Why? Because you haven't remained invested and allowed it the time to grow and regain. If you pull it out, you've done your dough. That's how you lose money in the stock market. Yeah. So responding to short-term volatility, responding to everyone saying the world's coming to an end, playing Chicken Little, if you like, the sky is falling, the sky is falling. Have faith in the tried and true methods of investing in the share market. Hold your nerve, keep your long-term goal, front of mind, and stick to the tried and true methods of investing in quality stocks. It's pretty straightforward. So if you've invested in blue chip shares, the value of those shares will go back up, as I've said, and I've spoken about the CBA example there. How to start investing in the share market. How do you start investing in the share market? Now, let's get into the nitty-gritty. How do you actually start investing? Well, the first step is to open a brokerage account. There are a couple of ways. There's a DIY version. There's a robo-advice type version, and then there's the stockbrokers. You can go to a stockbroker and they will take a commission on every buy and sell that they recommend for you, and that's a done-for-you service. A DIY version is something like a CommSec or a NAB trade. They're the two most common ones. How do they work? Well, if you go to CommSec, that's the Commonwealth Bank. CommSec is a trading platform attached with a bank account. So the bank account is attached to the trading platform. You'll put money in here and you'll go into the trading platform. You'll pop in the code. CBA is the Commonwealth Bank shares. You'll have a look and see how much it's worth. And if you buy a certain parcel of them, a quantity of them, once it wants to settle, it'll take the money out of the bank account and away you go. And that is the platform on which all of your shares will be listed. NAB trade is the same. That's a DIY version. Lately, there's been a lot of robo-advice type options such as SIFE and StockSpot. And what you'll do is you'll go into those particular platforms and you'll answer a series of questions, and they're goals based. So you'll answer a series of questions, they'll assess your risk profile and your end goals, and they will recommend a pre-populated done for you service based on what you're trying to achieve, where you're at. They are really, really powerful, and they take the guesswork out of you having to make those decisions. So DIY, you make the decision. The robo-advice, SIFE and StockSpot, they're just examples. Raise is one of them as well. This is not a recommendation. This is just have a look at these options. There's a multitude of options out there. There are done for you robo-advice type options, and there's going to a stockbroker and building a relationship with one of those, and that's a done for you type of service. They are all the different ways in which you can set up an account and start investing in the share market. So they are probably the most popular ones that exist at the moment, and quite easy to do simply because you will be able to download those apps such as Raise. You'll be able to download, I'm pretty sure CommSec and NAB Trade will have all of those. You can download them on your phone and easy as, and you can go with any one of those options. Very, very easy to do. What you'll find is when you DIY it, from a diversification point of view, it's a little bit harder because if you're buying each individual stock, you're going to need a lot more cash to do that. The only other alternative would be you'd look at ETFs, which are exchange traded funds that invest in, here's one. Vanguard is one of the most popular fund managers that have an array of ETFs, exchange traded funds, and one of their exchange traded funds is VAS, VAS, and that's the Australian shares ETF that they have. And last time I looked, they invest in about 314 of our top listed Australian companies, just much like I was talking to you about the All Ords, the top 100 or 200 ASX companies. By buying one of those ETFs, you get exposure to about 314 different Australian shares, Australian companies. That last time I looked, VAS share price was $101 to get one of those. So it costs more, but the diversification is huge. So that's another way of looking at it. But certainly do your research. If you're more comfortable with a stockbroker, go to a stockbroker. But they're the different options of how you can invest in shares. But before you rush in, here are some important things to consider. I want you to consider these things. Consider your investment goals. Again, goals are really, really powerful. Are you investing for the short term? I wouldn't suggest that the share market is for the short term, because share market is by its very nature a long-term hold. So long-term retirement or to generate a passive income, what are the goals we're trying to achieve? Because if you're trying to generate a passive income, you'd be looking for more of a high yield. You'd be looking for a share that's going to provide a greater dividend and a high yield type share rather than more of a growth type share. So not every share and not every company is created equal, and they will have different purposes. And so when you're looking at investing in shares, you'll want to know what the goal is. If it's to build long-term growth, you want to be looking at shares that are more in tune to building that long-term growth, versus if you're trying to provide a passive income for yourself, you'll be looking at shares that provide a really good high dividend yield to support that passive income that you're looking for. Research before you buy. If it's a DIY, if you're going to do this yourself, it's crucial to research the companies you're interested in, right? Look into their financial health, their industry position, their growth potential. You don't want to buy shares in a company just because someone else is talking about it. Be very, very careful about taking free advice from family and friends. And this is no offense to your family and friends and to, people who love to share free advice and don't necessarily do it themselves. And I've seen it time and time again. So make sure you follow the tried and true methods of investing that I spoke about before. So make sure it aligns with your goals and make sure you're sticking to the tried and true methods. Diversify your portfolio. So don't put all your eggs in one basket. This is what diversification means, as we know. And it's essential to spread your investments across different sectors, asset classes. This reduces risk because not every sector or every asset class is going to outperform every single year. One year it might be like in the last 12 months, international shares just smashed it as a result of AI shares and the growth in that area. Next financial year it could be bonds, and next financial year it could be property, and then it could be, Australian shares. So you need to diversify across all of these to make sure that you're spreading the risk and you're able to partake in the profit in whichever asset class or particular sector that happens to be doing well at that particular point in time. You can diversify by investing in shares, as I mentioned before, ETFs and other financial instruments as well. So diversifying through ETFs is extraordinarily powerful as well. Takes the guesswork out of doing all of the research yourself and sticking to the tried and true methods. Understand the cost. Many brokers, they charge fees. So when you do it yourself, things like CommSec and NabTrade are relatively cheap. I think they may even be $5 or $10. I'm not too sure. I don't use each one of those. But every time you buy, it's called a trade. Buying and selling are trades, and they might cost $10 each time. So $10 on a buy, $10 on a sell, depending on if you go to a done-for-you service with a stockbroker, you want to know what their fees and charges are. They'll be charging a commission-based type fee. If you're using robo-advice type platforms like Syfe, Raise, StockSpot, as I mentioned, you want to be checking out what their fees are and what their ongoing trade fees, or maybe their ongoing fees to provide that ongoing done-for-you service as well. So drill down into the fees. Really important to understand that. Also, start small, yeah? You don't need a huge amount to start investing. In fact, it's often recommended that you start small and build your portfolio over time, but start small and don't think that you need hundreds of thousands of dollars to start investing. That seems to be one of the biggest fallacies that I hear all the time. Patience is key. Can I just highlight this the most? Patience is key. The stock market is not a get-rich-quick scheme. Yeah, it requires you to hold your nerve. It requires you to have patience. It requires you to have a level of knowledge and look at the historical trends of the share market, look at what it's done, and look at the trend of the graph. You'll see all these squiggly lines, and they are all the stuff that happens that people respond to and panic about. But if you look at the overall trend with these things, it is going up. Look at the trend of the graph, okay? And over time, the right strategy and consistent investing, you can grow your wealth over time. Patience, right strategy, consistency. You'll need to be patient. That's all I've got to say. The power of compound is real, but it takes time to see the results. So do not get embroiled in the overnight success, get rich quick. I see this all the time on social media, promising the earth, promising that, zero down, zero money down, no risk. We're gonna make you rich overnight. If that was the case, all of us would be doing that. It's not real. It doesn't exist. And true wealth requires starting small, having patience, building it over time, holding your nerve, and following the fundamentals that has been around forever and a day. Okay, tip number 4. Number 4 tip for successful investing in share markets is know that you need to know how to get started, right? So let's talk about some of the tips for successful investing. Much like the tips that I gave you before, set realistic expectations, right? Understand that the market goes up and down, and there's going to be times when your investments are going to lose value, without a doubt. But again, you got to hold your nerve. As long as you stay committed to the long-term goal, as I've mentioned before, if the long-term goal hasn't changed, then you don't change. You can weather all of these storms. Stay informed. Keep an eye on the market and the companies in which you invest. Read financial news. It's always really good to educate yourself. Watch earnings reports and be aware of market trends. Don't try and time the market. No one can. If I could have timed the market or anyone else, we'd all be doing it, and we'd all be sitting in the Bahamas sipping on a pina colada, wouldn't we? Many new investors make the mistake of trying to sell at the right time. The market is forward-looking. So by the time it's happened, you've missed it. Studies show and research shows that you've just got to remain invested. You cannot time the market in when to come out and when to go in. By the time you've come out, it's already gone. By the time you've come in, it's already gone. You can't time the market. It's about the common adage is it's not timing the market, it's time in the market. So the truth is no one can predict exactly when the market will rise or fall. So instead, you know what I'm going to say, right? Focus on the long-term investment strategies and use things like one of the most powerful tools you can use is called dollar cost averaging. Long-term to say, add a savings plan to it. So if you've put down $5,000, $10,000, whatever it might be, into an investment portfolio, such as a CommSec, and you've started buying some shares, continue to put in that platform. Remember, there was the trading platform and the bank account. Every single week or month or however you get paid or pay cycle, start investing into that bank account so you can continue investing on an ongoing basis. That smooths out volatility, allows you to come into the market at highs and lows, and smooths that out for you as well, so you're not picking the market. So when there's a low in the market, it means that the share prices are down. And what does that mean? When prices go down, girls, there's a sale on. Yeah? So that's the time to buy, when it goes down. But most people see the market go up and say, oh, I've got to buy those shares. You've already missed it. You've already missed it. You've got to go in when it's down. Now, it's hard to time when markets are down, and it only really happens at, unfortunately, really, really bad times like Ukraine wars and GFCs and pandemics and things like that. And that's why we use dollar cost averaging, because we can't time those things, and those things don't happen all the time, thank God. So because markets go up and down all the time, dollar cost averaging, slowly drip feeding the system, is the best strategy to go. Okay. Obviously, I'm going to talk about financial education, right? If you're unsure about where to start, consider seeking financial education, without a doubt. Knowledge is power, and understanding and having the skills to make these decisions will put you in the pocket seat. You also need to review your portfolio regularly. Make sure you're all over it. Make sure you're taking control of it. Make sure this is the new you, okay? Check in on your investments periodically, and you choose what that period's going to be, and make sure you're still in line with your goals. Is it still in line with that goal? As your financial situations change, and they can, you might come into an inheritance, a windfall gain. You might increase your income. You might start a new business. All types. The kids might, you might be empty nesters. All sorts of things can happen that can increase and change your income. As your financial situations change, your investment strategy may need to be adjusted as well. And there you have it. So, a beginner's guide to understanding the share market and how to start investing. That's it. There you have it. While investing in the share market can be intimidating at first, and I understand that. I understand it can be intimidating. And I understand that because there's a lot of miscommunication around the share market. There's a lot of fear tactics. There's a lot of, oh no, I'm not going to do that. It's too risky. You know what's too risky? Leaving your money in cash. That's too risky. Investing in the stock market, the way I've just explained it, is the lowest risk investment that you can actually have, to be quite honest. And I know that kind of sounds like an oxymoron to you, but it's true. So while investing in the share market can be intimidating, as I've said, the key is to start step by step. Do your research. Keep a long-term perspective. Remember, no one becomes successful overnight. Patience and consistency. And you can build your wealth over time. If this is something you want to explore, please make sure to book a call with one of our strategists. All you got to do is go to wowwomen.com.au and click the link to our programs. And best of all, the strategy call is free. If you found today's podcast particularly helpful, please share it with a friend, leave us a review, and don't forget to subscribe so you never miss an episode. And until next time, take control of your wealth and your future, and I'd love to see you on the other side.